Bonds, bonds, bonds. You're probably sick of hearing about them because, well, they're not exactly exciting. But what's happening in the bond market right now is really important and will have real consequences for a lot of people. For those with a mortgage, to stock market investors, to people who have a job or depend on someone with a job, which is everybody. Nevertheless, I know you don't want to spend your entire morning learning about this, so I'm going to explain everything you need to know about the bond sell-off in under 6 minutes with no ad breaks. Alright, let's start the timer. You can think of bonds as a fancy IOU note. Imagine you've got $1,000 and decide to lend it to a company that we'll call Hodder Corp. Hodder Corp says they'll give you 5% every year for 5 years, or in other words, you'll receive a $50 coupon payment every year for 5 years, and then at the end of the 5 years, you'll get your $1,000 back. In that case, you were able to lend out and get back your $1,000 over 5 years, and in the meantime, you made $250 in interest. That's what a bond is. You're investing in a fixed stream of cash flows. In that example, you bought the bond for $1,000 and held it until maturity, but you also could have just sold the bond before the 5 years had passed on the bond market. The bond market is basically the same as the stock market. It's a secondary market where people are trading ownership in bonds. But unlike stocks, the future cash flows or the interest that you receive from a bond is fixed. If you buy my Hodder Corp bond from me, no matter how much you pay me for that bond, you'll receive $50 every year until the 5 years are up, and then you'll get $1,000. Which means if you pay me $1,000 for my bond, your return, or yield, will be 5%. But if you paid me only $800 for the bond, your yield would now be 10.3%. Or if you paid $1,200 for the bond, your yield would fall to 0.9%. There are all kinds of bonds with different lengths and different yields. And for the most part, the difference in yield between different types of bonds is a reflection of the likelihood of the borrower paying you back. For example, US government bonds, known as treasury bonds, have much lower yields than corporate bonds simply because it's less likely that the government will fail to pay you back than a company. The news at the moment about this great bond sell-off is specifically about 10, 20, and 30-year government bonds. In the last few months, the yields on these long-term treasury bonds have been rising really fast, with the 10-year bond going from a yield of about 3% in April this year to over 5% this week. And while that may seem like a minor move in terms of yield, it's had a major impact on the prices of these bonds, with prices down well over 10% this year and approaching minus 50% since 2020. And you might be thinking, yeah, I know, the Federal Reserve has been raising interest rates so the yields of bonds go up and the prices of bonds go down. And you're not wrong, but then why are yields rising so fast now? The Fed stopped raising rates in July. The reason is that the Fed doesn't even directly control the interest rate on long-term bonds. The rate decision we see every month, 25 basis points here, 50 basis points there, that decision really only affects short-term treasury yields. The longer bonds are exposed to a variety of other factors. Now, one of those factors is investor expectations for what the Fed will do with interest rates over the long term. For example, recently the yield on short-term government bonds has been higher than long-term bonds, which in part reflects the fact that everyone expects rate hikes to stop and eventually for interest rates to go back down over time. But that expectation is beginning to change. You've probably heard the phrase, interest rates staying higher for longer. It's the new buzz phrase for the shift in interest rate expectations. With the economy continuing to run hot and a number of other factors that I'll explain in a little bit, everyone's kind of waking up to the reality that 5, 6, 7% interest rates may become the new norm. The next reason why yields are rising is related to the Federal Reserve's balance sheet. During 2020 and up until mid-2022, the Federal Reserve was a net buyer of government bonds. They essentially printed money and bought bonds to push up bond prices and therefore keep yields low. Well, recently that's been reversed. They're now letting those bonds mature at a rate of over $100 billion a month, which is helping yields to rise because there's more supply than demand for these bonds. And speaking of supply, the US government is constantly needing to issue new bonds because of their enormous debt pile and the budget deficit, which just seems to get worse and worse. In fact, a large part of rising yields can just simply be explained as some sort of imbalance in supply and demand, whether it's an increase in supply or a decrease in demand. Okay, so that's why bond yields are rising, but what exactly does it mean for you and me? Well, yields across all kinds of assets are connected together. If the yield you can earn on a risk-free US government bond goes up, the yield that you demand on a corporate bond also goes up, or even the yield you demand on a stock goes up. And because prices and yield are inversely related, higher yields on assets mean lower prices on assets. The stock market has been falling recently, and many are blaming this on rising bond yields, which are driving stock market investors to demand higher yields on their investments. In fact, every single time bond yields have gone through this process of an inverted yield curve followed by long bond rates rising, there has been a recession shortly after. And it's because it's kind of a self-fulfilling prophecy. Higher corporate bond yields means debt for companies is more expensive, so companies earn less, and some of them will even go bankrupt. Some people will lose their jobs and spend less money. And at the same time, the debt costs for households also rises. 30-year mortgage rates just hit 8% in the US, up from just 3% a few years ago. All of this is to say that higher yields generally means that economic conditions are tighter, that it's harder for the economy to grow. So will we continue to see yields rise? Nobody knows. We can only really observe what is happening. No one's ever been able to accurately predict what bonds are going to do. Even Bill Ackman, who successfully bet on rising yields this year, is sitting this one out, saying there's too much risk in the world to bet against bonds. Let me know in the comment section below if you enjoyed this 6-minute explanation video, or if you prefer the deeper, longer explanation videos that I typically do. I thought for this topic specifically that I would experiment with trying a shorter or a different format, basically just because I think there's a lot of really good in-depth commentary on this topic already on YouTube. A couple of my favorites are Patrick Boyle and The Plain Bagel. They both have great coverage if you're looking for more on this topic.